Got it. Perfect. Awesome. Well, happy Thursday, everyone, and welcome back as always to We Wish You Wealth. As stated multiple times, you have the usual subjects, myself, Dani Sommer, Miss Ruby Ramos. I love your top today, by the way. Very pretty.
You.
Mr. Gordon.Chavez, and returning back with us for the second Thursday of this month, we have Mr. Shanne Sleder, mortgage advisor, 22 years based out of San Diego with RMW Home Loans. How are you today, Shane? Thank you for
Um,
joining us again.
Thank you. I'm doing very well. Thanks for having me.
We're definitely glad to have you back. You gave us so much information last time, and my brain is still twisting all of the knowledge that was received. My parents were definitely pleased with the information that they got, considering, reverse mortgage, and they are at that age where they're seniors and it could be beneficial to them. So we thank you very much for all of the questions that you answered, the information that you provided, and just the knowledge that you blessed us with, the last Thursday that you joined us. So we're definitely glad to have you back. We appreciate your time that you are giving to us. And we're excited for today because, I mean, not only in the market, the stock market, are there fluctuations going on right now, which is what we have to deal with as insurance agents with index allocations and all kinds of other things. But there's definitely fluctuations in the housing market. I know that we did speak last time on reverse mortgage. However, I think today we're going to take the approach of, kind of predicting the forecast of what the housing market is doing, rates, prices, inventories, all of that stuff. So, just to get a better idea, is now a good time to buy, as a married couple, a single person, whatever your situation is, like, how could this either be beneficial to you, or maybe perhaps not so beneficial to you based on what is happening. So, before we get started, I would like to, if based on the fact that, I'm back in Oceanside, which is where I'm from, visiting family and friends. I'm normally in Hawaii these days. But here I am. It's beautiful outside, if you can't tell. Um, so we know that you're based out of San Diego. We do want, for anybody that's close to us, obviously we're all in the same area in North County, for us to be able, if somebody relates to you or has questions for you and can reach out to you, what is going to be the best modes of contact for them before we get started to reach out to you with any questions or concerns that may have.
Yeah, so you always can look me up online. My website is san diego mortgage news.com. You can go on there. I've got a lot of information hosted there, and obviously all my contact information will be there as well. You can reach out to me directly. My number is 858-829-7186, and that's a direct line that you can either call or text. And my email address is my first name, Shane, with two N's, my last initial S, at rwmloans.com. So any of those ways are great ways to reach out. I'm also on all the different social platforms, Facebook, Instagram, LinkedIn. You can find me there as well, and message me that way.
Awesome. Thank you so much for providing all of that information to us. So, I mean, if anybody has any questions, if the reverse mortgage topic that we discussed is something that relates to you, or if what we're discussing today relates to you, or if you just have any real estate questions in general, by all means, Shane is going to be a definite valuable resource to you based on the fact that we already know that Mr. Gordon.Chavez has worked with him. He's trusted, respected, and he's literally wants to help you and in every way that he can. So, and that's just the main goal of what we're doing, right? Is providing education and helping people with things that, the scary questions get answered by people that you can depend and rely on, and that they're always going to be there for you. So we understand that you are licensed in the state of California. NMLS ID number is 239958, and the DRE number is 01174642. So based on the fact, just in case that you guys were like, this guy, I'm not so sure. He's got credentials all around. So he's legit, too legit to quit. But I guess transitioning into the conversation, like I said, we had so much information that we received about reverse mortgage. And I know it helped my parents. I know it helped a lot of friends and family. But what if, like I said, there's a lot of fluctuations going on with not only the stock market, the housing market. So we kind of want to, based on the fact, like I said, I'm single, I'm not married, I don't have children. Based on the fact that there are these fluctuations, we may potentially have some questions as to what it is that's happening. Like, what are you receiving information about? All of these kinds of things. So we're going to just, like we did before, do a little Q&A, and see what we can figure out as to now, if now is a good time to buy or not, or, invest in real estate or not. You seem like a pretty well-educated and well-versed gentleman to be speaking on this topic about, so I'm definitely very excited. And based on the fact that Ruby's got this really pretty pink fluffy shirt on, I want her to ask the first question, because I feel like she's got some good stuff for us today. She's got questions coming your way.
Thank you, Dani. It's actually a dress.
Oh, is it? That's really pretty.
Thank you.
I love it.
Well, thank you again,
Girl.
Shanne, for being here with us. We truly appreciate it. But I do have some good questions for you that I'm sure everybody is also asking themselves. The question I have for you is, can you tell us what is happening in the current housing market with rates, prices, and inventory?
Sure. Yeah. So obviously, the housing market, the way that what's happening in the market is going to be more based off of where you are nationally, right? There's going to be certain areas that the markets are doing things different than other areas. The Midwest may be a different situation than we have here on the West Coast, right? So from that perspective, you do have to look more on a micro situation versus macro. But as a whole, even if we look at the national setting for real estate right now, we are seeing home prices appreciate. And I think the most recent forecast is that we should see a 5% appreciation rate at least nationally for 2024. And then if you look locally, here in California and San Diego, we've continued to have a very strong market. We had a slowdown at the very end of 2022, as rates were starting to tick up. And then basically beginning February or so of 2023, we started to see home prices go back up again. And so now we are at a position where, if you own a home, you're seeing that appreciation continue to grow. If you bought a home recently, you're still seeing appreciation grow. So prices are still going up. I don't see anything that's going to have or show prices coming down. We actually recently, with the rates being higher, everyone thought that home prices would start to come down. And again, we saw that for about a 3-month period of time in late 2022. And there are some housing markets that were a little maybe overheated that are still seeing a little bit more of a pullback. But here in San Diego, we haven't seen that. We've seen prices continue to go up. And so even with the higher interest rates, prices have gone up. So I think that that's going to stay consistent. And, rates right now are in around the 7% range for a 30-year fix. They've come down from the highs of where they were back in October. We were almost up to 8% with rates. And so they have come down a little bit from that. We did get down into the mid, like or about 6.5% recently, and then they have ticked up here just in the last month or so. But when we look at what the forecasts are, we can see that whether it's Fannie Mae or the Mortgage Bankers Association or even the National Association of Realtors, they all see rates continuing to come down through this year and into next year. We see the forecast for 2024 by the end of the year, Fannie Mae is saying it should get down to around 6%. The National Association of Realtors is saying 6.5%. And then in 2025, we're down to around the mid fives potentially. So there is an opportunity that even if you get into buying a house now, that you're gonna be able to refinance and get a little lower rate later on. And what's caused the rates to be elevated is just some of the inflation that's occurred over the last number of years. And so the Fed had to step in to try to curb inflation, and they had to raise the Fed funds rate, which was kind of the short-term interest rates, but it doesn't have a direct correlation to mortgage rates because mortgage rates are more long-term. But because of inflation being higher, that hurts long-term rates, and therefore those rates had to go up. So as inflation numbers are coming in a little bit lower, we should start to see the interest rates continue to come down to a lower point. Oh, and then inventory. We didn't talk about inventory. So again, that is going to be based off of where you live. I know in San Diego and a lot of areas throughout California, inventory is still very tight, meaning that there's not a lot of houses on the market to be sold. And that's due to the fact that over the last number of years, we had so many people that owned a home lock in an interest rate of 2.5% to 3%. And so that's made it difficult for them to be motivated to go out and sell their house and move someplace else. Most of the people that are selling because they have to, either they're moving out of state or their jobs have changed and they've got to move, or maybe it's a death in the family or something like that. You're not getting a lot of people selling just to sell to buy that next home, because then they'd lose out on their lower interest rate. So you've got people who maybe are older, who normally would think of downsizing, who are holding on to the house because they don't want to lose that lower interest rate. Now, in areas where there's more new homes being built, a lot of parts of the country, there are a lot of new homes being built. And so that is helping with some inventory because a lot of new home builders right now have homes that are available. But in San Diego County, we don't have a lot of new homes being built. And so it's hard to keep up with the demand. And so what that's doing is that is continuing to add that upward pressure on home values because there's not a lot of inventory available.
So for my understanding, the rates, so the interest rate, I wrote down a rate arrow up, price arrow down.
That would normally be the situation. As rates go up, in many cases, you would have home values coming down historically, but that's not what we've seen here recently in many markets. And like I said, in a few exceptions, yes, that's the case. There's still some areas, like I know Austin, Texas has had values come down and things like that. But in San Diego, especially, we are in a situation where even though the rates went up to about 8%, we still had home prices going up. And historically, that's not the case, but due to the low inventory and just the number of people who are wanting to buy and are in the market, that continued to cause house values to go up.
That was going to be my next question is, the people that are wanting to buy, does that affect the rate increase because there are a lot of people here, but a lot of people want to come here too. So, and I'm like, wow, is everything? I mean, I'm literally a couple blocks from the beach and every house is over $1 million in this neighborhood. I feel like I'd never be able to afford something like that, especially as a single person. But I guess my next question based on that is, what is the lowest interest rate historically that you've been in the industry that have you seen for the housing market?
Yeah, so the lowest rates that we've seen were back in 2022, 2021, 2022, when we're in the middle of the pandemic and the Fed really stepped in and did a lot of things to manipulate the interest rate environment to cause rates to come down so that people could refinance and get some more cash going into the market and save some money. And they were doing that to try to just save the economy, right? And so rates did not come down to 2.5% naturally. They were lowered that way. They were forced down based off of what the Fed was doing. And I mean, that historically 7% is kind of the average interest rate. When you go back and you look over the last 50, 60 years, 7% is kind of where we are. But what happened is people got very accustomed to that 2.5%, 3% interest rate. And really what happened is the Fed kept the rates down too long. And therefore, because they kept the rates down too long, that caused too much money to come into the market and therefore inflation to start to become rampant, right? And then all of a sudden they had to switch gears and they had to increase interest rates to try to keep inflation down. And that's why we saw, long-term 30-year fixed rates. Once the Fed was no longer manipulating and pumping money into the market, and really what they were doing, this might be getting a little technical, but interest rates are based off of mortgage bonds that are sold on the secondary market. And so the Fed was coming in and actually buying those mortgage bonds to keep rates low. And so once the market shifted to where they didn't want rates low anymore, they stopped buying the bonds. They actually started selling the bonds, which put more out on the market. And we saw interest rates go up, and that's where we were with the almost close to 8%. Again, historically, that 7 to 8% is kind of more where it is. But now that home values have gone up as much as they have, people who are used to 2.5%, 3%, it becomes a little bit more difficult to see what a payment's going to be at a 7% rate on $1 million loan, right? And so it has affected people. There are people who can't qualify now. Maybe they could have qualified a couple of years ago, but they're not able to qualify now with the higher rate and the fact that home prices have continued to go up. And so they're in a position where they've got to maybe look at other areas of the country that they might be able to afford a little bit better. Or they're waiting to see if interest rates come down, or we have to get a little creative and maybe get parents to come on and be co-borrowers with them, or to gift funds to them to be able to use for down payment. There's some creative things we can do, and I know a little bit later we might talk about some first-time homebuyer programs that might help as well.
Right. Yeah, we'll definitely plan on getting into that, but that's like a large fluctuation in just 2 years based on what the Fed had to do. So, I mean, the average seems normal, at that 7%, but to have it be at 2.5, like that's incredible. Like,
yeah, that's insane.
I'm like, well, I should have jumped in on that.
Yeah, it was a pretty quick rise in interest rates. In fact, it was one of the fastest increases that we've ever had, and that's why the housing market kind of came to a halt there for a while. And many real estate agents, many loan professionals got out of the business because there just wasn't enough there. But it really, unfortunately, it was needed because we needed to get inflation under control. And now we're back towards getting, inflation under 3%. The Fed really wants us to be closer to about 2%, which we're not quite there yet. But I think once we can see that inflation is fully under control, that's why the forecasts are for the rates to go back down into the mid 5% range, which I think is going to be helpful. But what I would say is anyone who's looking to buy right now or is interested in buying, if you wait, I have a lot of people say, you know what, I'm waiting for two things. I'm waiting for either the home prices to come down or I'm waiting for interest rates to come down.
Great, yeah.
Well, the home prices haven't come down in about 10 years, right? So they've just continued to go up. And like we said, if they didn't go down when the rates were at 8%, we're probably not going to see them come down very much as rates come down more. The other thing is that as the rates get closer to 5.5%, what happens is that brings more potential buyers into the market. Now you've got people who couldn't qualify at the 7%, but now can qualify at 5.5%. And so now instead of a house having 4 or 5 offers on it, it might have 10 offers on it. And what's that going to do? That's going to continue to push the prices up. So it really makes sense if you can get in, if you're looking to buy and you can afford it now and you can make the payment work. Obviously we don't want to put people in situations where they're going in over their head and they're paying way more than they can, and then they end up going into foreclosure or having missing mortgage payments. But if you can qualify, even if the payment's a little bit more than what you want to pay, and maybe you have to stretch yourself a little bit, the goal is to get you in now before the prices continue to go up, and then be able to refinance that property later on, hopefully at a lower interest rate, get you a little payment relief. It's never a guarantee that we can refinance you, but usually we can make that work. Because the issue is if home prices are going up 5% a year, and you're trying to put yourself in a position where you can save more money to put down, so you have that 20% or more to get that payment down, you're going to have a hard time outpacing the appreciation to save enough money to put that 20% down.
Right. Wow. Thank you.
Yeah.
So wait till the interest rates are low and the prices are going to keep rising. So it's still either buy now or don't.
Or don't buy at all.
Well, I think, one of the questions that always comes up is it a good time to buy? All right. That's kind of probably something that's always asked is it a good time to buy real estate? My question would be, there's really never a bad time to buy real estate if you have the right goals in mind, right? If you're trying to buy real estate and flip it within a year or, buy it for a short-term period of time, that's where more of the risk comes in. But if you buy it and you hold, I've got a graph in front of me that I'm looking at that shows from 1942 all the way through, if you hold a property for 10 years, if you buy it and hold it for 10 years, there's only 1 year where you did not make a profit over that 10-year period of time. And that was in 2006, which is when we had the housing crash. Home prices were at the highest point at that point in time in 2006. And then we had the housing crash. And for the next, 4 or 5 years, we were kind of in a recovery mode where prices were going down through about 2011. So in that case, if you bought in 2006 and held it for 10 years, you lost about 3%. But in every other scenario, if you bought it in 2000 and you sold it 10 years, you made 47%. If you bought it in 2011 and you held it for 10 years, you made 67%. If you bought it in 2013 and you held it for 10 years, you made 105%, right? So every other situation, if you keep it for that 10-year period of time, you're going to make money on the real estate.
Right. And I understand, you say is now a good time to buy. We were kind of discussing this prior to going live. Gordon had mentioned, all of us do all of our marketing on social media. So we see a bunch of stuff about investing and assets and all of this stuff. I think Gordon had the first part of this question that he was speaking with you about that may potentially go into this what you were just discussing. And then I have a question for you because I know Gordon's married, he's got kids, all this stuff, and then I'm single, I have no kids. But everybody's like, don't buy real estate, it's the worst investment you could ever make. I know that was a topic of discussion. Obviously you're in the industry, so based on, how Gordon's life is completely different to mine, maybe he could give a little more insight as to, why now is a good time to buy for him and why now would be a good time to buy for me, and what those differences like may potentially be for the both of us, and how we can make real estate work for the both of us in this time. Oh, that you say that's never a wrong time to buy. So we'll start with G. If you can give a little, something, because but like I said, both of our situations are different. But if we both have the opportunity to start investing in other assets and expanding our portfolios, then, something may relate to you that may relate to me differently. So let's see
Yeah.
let's see what those differences are.
No, yeah, I think, Shane kind of touched on it already. It really has to do with your goals. If
Right.
buying a house, um, can fall under maybe three categories, I guess you could say. One can be you're just buying your house for your family to raise your family, to raise your kids and things like that. Another one can be a rental property where you're buying it, somebody else is going to live there, and hopefully you're able to make profits off of the mortgage or off of the rent and still pay the mortgage, or even break even, and just the appreciation of the home over time. Once you sell, like, you won't make any money right away, but once you sell, then you're going to be selling it for more than what you bought it for. And then, the last one is house flipping. If you're trying to buy a house, do something to it to improve the value and sell it within a year or 2 years or even less than that, then there's profit there. But, as far as my situation goes, Shane talked about the only time that there was a loss was, when the values went up, in 2006 and then came down crashing in 2008. And it's funny that you said that because I bought my house in 2006 and it took us a while. We were what do they call it? Upside down or underwater, where basically negative equity in our house for the first few years. And even then it took a while just to catch up, get back to what we paid, and then, have some equity built up after that. But we weren't in it to flip the house. We weren't trying to rent the house. It was really just to create a home for our family, our kids. And luckily, we've been here long enough now that we have some equity, and we're able to do things with that equity. And now I'm in a position where I'm trying to help my mom in the state of New York, and that equity that we built here in this house is coming into play and really helping us, and Shane was able to help us with that as well. And so it really depends on your goals, just like anything else you do. Like when we help our clients with, life insurance or retirement planning or whatever the case, it's about the goals. It's not about the product. It's, I mean, there's plenty of products, there's plenty of
Right.
options, there's programs. I know Shane's going to talk about some of the programs in a minute, but, for example, one of the things that we were talking about before we went live was, somebody is on a tight budget and they want to invest. You just have to crunch the numbers, and maybe a duplex or fourplex or something like that makes sense. It's a bigger investment, but if you're able to charge rent on, say, the units you're not living in, or if you're not living in it at all, it makes sense, and you're able to make a little bit of profit off of that on a monthly basis. But my situation and Dani's situation are very different. Dani's like, she's from Oceanside, and here in Oceanside in Southern California, I don't think you can find a house in Oceanside for less than 500,000. And it's probably even, that number is
And
probably
now
even
I
a
live
little
in
higher.
Hawaii. Come on.
And now Hawaii, right? I don't even know what the average, home value is in
Well
Hawaii. It's
over a
probably higher.
million, probably, depending on the
Yeah.
location.
Yeah, yeah, and then, as far as how close you are to the beach here in Southern California makes a big difference. There's been a push where people have been going farther and farther and farther away from the beach in the last, you know, probably 50 years, probably since about the 80s. People have been moving to, Vista, Fallbrook, Temecula, Hemet, just going farther, farther inland. and now it seems like people are moving out of state. You know, people are going to Arizona, people are going to Texas, and so if your goals, if that fits your goals and that works and it fits your budget, it's fine. But I think in general, you know, Shane talked about the average rates historically being about 7%. I don't know, Shane, and this is just a thought that came up as you were speaking. What is the average appreciation of real estate over time? I think I read somewhere at one point that on average it fluctuates, but on average, the value of a home is averaging 8-9% over a period of time. And I know you gave some really good numbers there, but
Yeah. So I mean, I have to look, you know, what it is nationally. I know if we do a look of San Diego over the last 30, 40 years, taking into account the downturn we had from 2008 to 2011, we're about a 6% appreciation over that period of time. Now, we've had much higher appreciation over the last number of years, and I think that that's going to, you know, continue to be if we look 10 years from now, if we look at the average, we're going to be higher than 6%. It's probably going to be closer to like an 8% average. But yeah, I mean, so the average is there for seeing, again, like you said, long term. I was in a very similar situation where we bought a condo in 2004, and we were living in it as our primary residence, and it was going down in value. And in 2011, we needed to, because we had our second child, we needed a larger place. And so we had to find a single family home that we could get into. And everyone was saying, oh, you should just, you know, short sale the condo and you know, get rid of it. And you've lost money on it, just get rid of it, like so many people did. And I said, no, I'm not going to get rid of it because it's going to recover at some point. Right.
yeah.
And so we kept it, and you know, it took a while for it to recover, but now the value on that condo is like $800,000. And, you know, now we've got a large amount of equity that is in that property because we kept it for the long term and we didn't do a short sale on it. So again, the longer you can have, the longer perspective you can have with properties, the better. We do know that there's sometimes where you can't control that, where things in life happen and you have to get rid of a property, you have to move, whatever that may be. But I think when you're looking at, you know, does it make sense to buy? Obviously, everybody's situation is different. You have to take that into consideration. But a lot of times when you're seeing things online and they're talking about, well, it doesn't make sense to buy right now because I can rent a property for $3,500 a month, and my housing payment, if I bought, would be $5,000 or $5,500 a month. They're looking at that as in a very short-term scenario versus looking at what is that going to be over a long term. And there's a lot of factors you have to take into place. You have to look at what are your tax savings going to be, because as soon as you own a home, you can write off your interest and your, you know, portion of your property taxes. That's going to bring that total cost down. When you make a mortgage payment, you're paying interest, but you're also paying principal. And when you're paying that principal, you're paying your loan down, which is giving you equity. So part of that payment is going back to you. You're not really paying it to the bank, you're paying it to yourself. You're investing in your future retirement with that. The other thing to look at is when you own a home versus renting, you're getting appreciation. So if you're making 5% on an $800,000 property, that's $40,000 a year. That's going to far surpass the difference between your rental income or what you're paying for rent and what you're paying for, you know, be paying for your mortgage. The last thing to look at is when you get a loan, you are basically locking in that payment for the next 30 years. Your interest, I mean, your property taxes could go up, your insurance could go up, but your mortgage payment is staying where it is. And if you can refinance to a lower interest rate, then that payment will go down, but it will never go up unless you go in to pull out cash or do something to make that payment go up. Versus when you're renting, that rent can go up every year. I think right now the annual rent increases are about 6%. So you may be starting at $3,500, but in 10 years, you might be closer to that $5,500 a month. And so you have to take that into account as well, because I know people who have been renting for 10, 15 years, and Now they're in a position where they have a hard time being able to get into buying a property because they've fallen behind the curve in many ways, right?
Yeah.
So I think the longer you rent, the harder it is to then get out of that cycle and be able to purchase a home sometimes.
Yeah, it's going to be a sacrifice one way or the other for the most part. But I mean, I know people that have owned a home for, 30 years, that have a mortgage and their mortgage is 800-900 bucks. Not here in Oceanside, but I'm looking at New York and it's like, you have a mortgage of 800 or $900 a month on a home that you've owned for 30 years, when the average rent out there for that same home is probably $2,000, and so does it make sense? Yeah. I mean, unless you're trying to flip it and get rid of it, and that's a totally different scenario, but maybe Shane can help with that too, because there's programs out there.
Right. Based on the fact that you mentioned programs,
Yeah.
Rubik, what you got?
I was gonna say the same thing.
I'm all
So
there.
I was gonna ask,
You
like,
tell me. No, I'm just kidding.
what type of loan programs do you offer?
Yeah, so we have all types of programs. We've got the conventional conforming Fannie Mae, Freddie Mac loans. We've got jumbo loans for those that are buying, higher priced properties. We've got FHA loans, which are usually better for low down payment, lower credit scores. VA loans, which are for veterans who've been in the military, and we can do 100% financing with those. So a lot of different just kind of general programs. I think the big thing to look at is a lot of times people think you have to have 20% down to get into the housing market.
Mm-hmm.
And with FHA loans, it's as little as 3.5% down. We've got for first-time home buyers with some conforming loans out there, you can put as little as 3% down. So there's ways to get in with very low down payments, and those down payments can be gifted. They can be gifted from a family member, right? Maybe your parents can tap into their equity that they've got to help give you money for a down payment, or they've got other funds that they can help with. So there's ways to get in with not a lot down. And then there's some first-time homebuyer programs that are out there that are geared more towards, being a first-time homebuyer within the last 3 years. There's some grant programs where it can help with giving you either money for down payment or for closing costs. Different cities and different counties have some of their own programs that are available. And then I know the state of California has the CalHFA program that is throughout the state of California. And those are really geared towards giving money for helping with that, maybe that 3% down payment or some of the closing costs. Now, what you have to look at when you're looking at these down payment programs is most of them have income limits where you can't make over a certain amount to qualify for it. Or you can't have over a certain amount of money of your own assets sometimes. So there definitely are guidelines that we've got to look at to see if we can kind of fit you in that program and see if it works. But there's one program out there right now that I'm really excited about that's called the Community Lending Program, where you don't even have to be a first-time home buyer. There's no income limits. And basically what it does is based off of the location of the property. There are certain areas that they're really trying to get more investment in. And so what happens is you don't have all of the normal adjustments that you might have on a loan for putting a low down payment down, or maybe having a lower credit score, or maybe it being a condo versus a single family. And so what happens is maybe the rate right now would be 7% for a normal program, but if your property fits into this program, you might be able to get it at 6.5%. So you might get a full 0.5% lower interest rate, or maybe even some cases it might be higher than that. So that can really help people qualify for more and get that payment down. And again, the nice thing is it can be for anybody. It doesn't have to be based off of your income qualifications or being a first-time home buyer. So that's one program that's really exciting right now. Many people might have heard about this California Dream for All program, which is a first-time homebuyer program from the CalHFA, state of California. And that is where they'll give up to $150,000 or 20%, whichever is less, for a down payment. It's a future equity share situation where they will basically, the way they get paid back is when you go to sell the house in the future, you pay back whatever you borrowed plus up to 20% of the appreciation. So it could be, expensive to do that, but if it gets you in, it may be a good option. That does have some income limits as well, but they've got higher income limits. But the thing with that they made a change here recently is if it's at least one of the buyers has to be a first generation homeowner. So if your parents have owned real estate, that would disqualify you, right? If there's two borrowers, at least one has to be a first generation. If it's one borrower, then that person has to be a first generation home buyer. The other thing is that the last time they rolled this out, they ran out of money within about 2 weeks. So this time they're doing a lottery system where you've got to send in your information and they're going to randomly draw who could qualify for this program based off of where you're located.
Right.
The drawback of this is that they're assuming they're going to get about 20,000 applicants, and they only have enough money for about 1,800 people, right? So it's going to be a small portion of people that get it, but it is an option out there right now as well.
Why are they
Wow.
offering the program if they don't have the means to, I mean, they know that they're gonna have multiple people applying. Like, why are they so ill-equipped to be prepared to provide for maybe even people who do qualify for those, only 1,800 out of 20,000 or whatever it may be?
Well, because the money is based off what they have in the budget, right? And the budget from the state of California, I think they gave them about $300 million. So it's a decent amount of money, but the problem is when you're giving up to 150,000 out to help with down payments, it doesn't last as long. So they have limited funds, and many times some of these grant programs and down payment programs will have periods of time during the year where they'll say, well, we can't take any new applicants right now because we've run out of funds. We have to wait for our next round of funding. So that's something that can happen. So many times, if you can get away with qualifying without a down payment assistance program, and again, maybe get some help from relatives with a down payment, with the gift funds, that's going to be your best and easiest way to get qualified. But if you do need a down payment program, we've got a great tool that we can plug in your information very quickly, and we can then spit out all of the down payment assistance programs that you would potentially qualify for, and then just try to see which one would be best for you.
So then at that point, what are some of the qualifications that you would need to have to receive that down payment in order to be qualified for that?
So each program is different with what their guidelines are and what their income levels are. A lot of the programs are capped at like 150% of the area median income. Some of them are at 120, some of them even go down to 80%. So you've really got two things that you're looking at. You've got to make enough money to qualify for the payment on the mortgage side, but not enough money to where you don't qualify for the down payment assistance. So
Right.
it's sometimes it's squeezing people into a very small window to see if it would work for them. But there's credit score requirements. There's maximum amount of assets that you can have. It would be too difficult to get in all those things right now, but that's what we do when somebody reaches out to us and wants to know what they can qualify for, and if there's programs available, we plug all of that information into our system and then help determine which programs would be available for them.
Okay, that makes sense.
Okay. I have a quick question that just kind of like jumped into my head. So for these programs, I was wondering, what about like mobile homes? People that have mobile homes.
So there's a difference between a mobile home and a manufactured home. So a mobile home is where the property is on an axle or can be moved easily. It's not on a permanent foundation, right? And you see that sometimes with these mobile home properties where they're renting the space below them, and then they've got a mobile home. So that's not considered real estate. Those are more personal assets, a mobile home, and you can't get traditional financing on that. You have to get special mobile home financing.
Okay.
Now, a manufactured home, which is a home that's been brought in, it's been completed someplace else, has been brought in. Yeah, those are the ones that sometimes you see driving down the freeway and they're cut in half, right? And they're going on these huge trucks. That's a manufactured home. And then it's brought in and it's put on a permanent foundation, and you own the land underneath it. Then that we can do traditional financing on. And so those programs would be available on a manufactured home.
Okay. Okay.
That was a really good question. And I mean, I've seen these the Amazon pop-up houses for $16,000. We're apparently gonna get one just for my cat. And does that count? As a mobile home, or you know what I mean? But yeah, it's something to be considered. But I was told I couldn't have a cat unless it had its own home. So that's the goal. Based on the fact that we're talking about all of these other things that, first time buyer stuff. Let's see, based on the fact that you own your home, G, or you just work with Shane to get, a property for your mother and all of that stuff. Do you have any questions based on, where her status is and what may be potentially good for her?
So on the last episode, we talked about how I have actually been working with Shane, or I have worked with Shane, and he helped me tap into the equity of my house where I live here in Oceanside in California. And I needed funds to be able to help my mom who lives in New York because her housing situation is changing right now. And so, so if you're looking to do that, Shane's a great resource for that. Reach out to him. He can help you figure out ways to tap into the equity. But that can be for anything. If you're helping a family member, I know there's programs for helping family members maybe on a fixed income, getting into a home at a lower down payment. That's something that we're kind of looking at right now. And then also if you're just looking to tap into those funds to be able to invest in, say, rental properties, because that's another thing that we're looking at, where one of the units will be my mom, and then any other units that might be on the property or whatever, or it could be a duplex or fourplex, will be rented out. And so maybe you can share some of that as far as helping people tap in through refinance or through HELOCs. I don't know what kind of information you might have on that, Shane.
Yeah. So I think as far as refinances go, I think there's a couple different reasons why people might look at refinances right now. One is if you did buy 6 months ago or sometime in October when the rates were higher and now rates are coming down, at some point it will make sense to refinance and go from that higher rate to a lower rate. And so that's one of the things that I always do is I will do a free review for people to let them know, a mortgage review to let them know, like, does it make sense to refinance now? How much could your savings be? Or when do we need to wait? Like, what number do we need that to be at to have it make sense? And then I can keep people updated as rates change to whether or not it makes sense to refinance. So that would be one reason. The other reason would be to potentially tap into, home equity, like you mentioned, to do different things. And there's a couple different ways that can be done. You can do a traditional cash out refinance where you would replace your current loan with a new first mortgage, and let's say you owe $300,000 right now and you want to take out $100,000, you'd have a new first mortgage for $400,000, and you'd get that $100,000 out, and that would be a new 30-year fixed, or whatever we decide to do. Or you can do a second and there's a home equity line of credit seconds, there's fixed rate seconds. And so there's different ways to tap into money that way as well. What I'll say is that I was just reading, that consumer spending or consumer debt in the US is at all-time highs. I think I read we're at $16 trillion. And so, we have a lot of credit card debt out there. And car loans and, other and equity lines and the equity lines can be a great tool, but they also come at a higher interest rate than a traditional loan does, right? So what we want to look at is when we're looking at, does it make sense to get an equity line or does it make sense to just take out a new first, is we want to look at what's called a blended rate. Like what would that total payment look like with doing a first and second, or what would it look like with just doing a new first mortgage? Even though your interest rate may be higher on the first mortgage than what you currently have, if you're paying off credit card debt at 22%, or if you're doing some of these other things, it still may make sense to do a new first mortgage versus an equity line with where the rates are right now. So depending on what your goal is, what you're looking to do, what you're looking to pay off, there are some different programs that we can look at to help get you access to that home equity and put it to work for you in one way or another.
And I have a question, because you talked about jumbo loans, we're talking about HELOCs. There's so many different options just based on the circumstances of where you are, that you really need to kind of, I'm obviously understanding you really need to sit with somebody like you to really realize what the best option is. And maybe, people, I've never heard of a jumbo loan before. I don't know what that is. You know what I mean? And how do they operate, and what times do you need to utilize them? There's so many different options based on the circumstances of where the individual or the family is in the situation that, we don't necessarily maybe realize that are beneficial to us.
Right.
And
yeah,
so,
and I'd say that's, like you said, that's where sitting with somebody like myself who's been doing this for over 20 years, a true mortgage advisor, versus, a lot of people nowadays think that what they want to do is the quickest, easiest way to do something. And so they'll pull out their phone or they'll get on the computer and they'll go in and they'll put all their information online and they'll get a pre-approval letter back and they'll go out and they'll buy a house and they never sit down or talk with anyone, right? And the issue with that is you're buying probably one of the largest assets you're ever going to have. You're getting one of the largest debts that you're ever going to have.
Right.
Why would you not take time to sit down and meet with somebody and plan it out, make sure you're making good decisions and that you're structuring things properly? It's a mortgage can be a complex tool and it can get you into trouble if you don't do it right. You can go into foreclosure, you can lose your house. You want to make sure you're making good decisions. And people will go and spend an hour at the hair salon to get their hair done, spend an hour sitting down with me for their largest decisions that they're probably going to make in their life, right? And so it is very important to have that conversation. I will do a pre-purchase consultation or a refinance consultation with all of my clients where we will look at all the different options, what's making the best situation for people, and trying to give them the best options out there.
Right. Yeah, and us as life insurance agents, obviously we wanted to start incorporating, a diversified type of approach to what we have to educate people on and all of that stuff. But, we have to do the same thing and really realize, what is your goals? How can I really make the products that I have for you extremely beneficial to you and your family, and what are you trying to achieve and all of that stuff. So, and we appreciate that you're on the same page with the educational values that we're providing to anybody that's watching and all of that stuff. So, thank you.
Thank you for having me.
Yeah.
I got a quick question if you guys don't mind it. Shane, we talked earlier about people leaving the state and going to other places because the cost and the values are lower. Um, and I know you're licensed in multiple states. What is that something you're able to help with? Like if says, I have this house here in Southern California, I'm thinking I want to move to Texas or whatever. How would you help, I guess, somebody really figure out the best options for them, whether they're gonna sell the house and use the profits basically to
Right.
buy a new house, or is that something you're able to help people with,
Yeah.
I guess?
Definitely. So I'm actually licensed in 9 other states. Most of the states that people from California are moving to. So, the Texas, the Florida, the Idahos, Tennessee, along the West Coast, Arizona, Nevada, Washington. So got all that covered. And then my company is licensed in 16 states total. So even if I'm not able to do something, there's some other areas that, other people that I can refer people to. But that's what we'll do is we'll sit down and we'll look at, their current situation here. And, if they were to sell, how much could they net out of the sale of their house? And then what could they do to buy? I've got a lot of clients that I'm working with right now that are doing that same thing. Like, does it make sense to sell our house first or to buy the next house first? And can we go in, can we buy that next house without having to sell our house so that we can be non-contingent on the offer and not have to wait for that? So I will definitely have those conversations and sit down and help make sure that you're making a good decision with that move. And I would say a lot of times people will think, well, let's just take the money from the sale of our house here and buy that next house with cash. And I'd say, you know what, let's discuss that, because it may not make sense to bury all that money in your house. Maybe if you want to have a low payment, go in with 50% down and get a loan for 50% of the amount, and at least keep money liquid that can be used for retirement, for other purposes, to, renovate the house, whatever you might need to do. But as soon as you put all that money in the house, you can't get it back without doing a cash out refinance, which is going to cost you more money.
Yeah, great point. Because you hear stuff online about multi-millionaires getting mortgages. And so I mean, they could buy these houses cash, right? But why would they get a mortgage? And that's because of what you just said. You keep your money liquid and you use, the bank's money to get what you need. Yeah.
Yep.
Great point.
It's like using
Definitely.
life insurance companies' money to get what you need to invest in real estate. I mean, come on. It's all coming full circle at this point. You know what I mean? OPM, we're all about it.
Yeah, and again, to Shane's credit, is that's what he's looking at. He's looking at the whole scenario, the whole, whatever, all the circumstances about somebody's financial, situation, to offer them the best advice that's really going to help them reach their goals, and another thing, I'm trying to do something with real estate in New York. And Shane's not licensed in New York, but he still told me, if you need help, if you have any questions, reach out to me. And so he's really out to help, basically, business aside, right? He just wants to offer more value. So
Yeah. As do we all. And based on the fact that, that's our main goal, is to provide value with what we do. And now we're providing other resources of value to people. Like, it feels really good to be able to have access to other people with, in other aspects of finance, and, just really be able to help each other. So we definitely appreciate you, Shane, for joining us again, for giving us your time, for answering our questions, letting us know that now is the best time to buy, whether we think so or not. And encouraging us and empowering us to really take this step into the real estate journey in whatever way we are choosing to utilize it for. And I'm glad that we have you as a resource. Obviously, there are so many other things that we have questions about. just based on the conversations that we've had, this, we could do this all year. I don't know. We'll definitely be asking you to come back.
I appreciate it. I look forward to it.
Yeah. Does anybody else have any other questions? Because I know that we're just over the hour that we designated for you. If not, I do just want to say again, thank you so much for joining us. Thank you for your time. Thank you for the education. It's definitely been beneficial to myself. I'm sure it's beneficial to other people, and I can't wait to see you again.
Well, thank you. I look forward to it.
Yeah, thanks again for joining us, Shane.
Okay. Have a
Yeah,
great
thank you so much, Shane. And then, like we said, make sure you prioritize, just like you prioritize your 5-hour hair salon day. Because it does take more than an hour, just to let you know.
I do that every time. I
Yeah,
put a lot
Gordon's
of thought
been there
in.
since yesterday. Come on.
But yeah, just the difference that it's gonna take if you take the time to sit down with an actual advisor to help you out, it's gonna be super
Yeah,
beneficial for you and your family. So thank you again, Shane, for that information.
welcome. You're welcome.
yeah, we don't know what we don't know, and I obviously don't know a lot, and I'm not afraid to admit that. So, not only have you helped my parents, you've helped me as a single, not married, no child person, but you've helped them. You've already helped people, and well, you're going to continue to do so. We're glad that we can be a part of your journey and that you're a part of ours.